Hello, and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm TJ Sponsel. In today's episode, we will help explain the technical differences between sections 174 and 41 and how CPAs should be approaching this important topic with clients. Joining us today is Garrett Duffy. Garrett is a relationship manager at McGuire Sponsel, specializing in R&D tax credits in the Northeast markets. Welcome, Garrett.
Thanks for having me, TJ.
Full disclosure, Garrett actually has been with us for a number of years and is an expert in the R&D tax credits. Recently, he's now spending more time in the Northeast, where he's from, in upstate New York, and focusing on serving our clients. So, Garrett, as past year and a half, 174 has been a very interesting path for us at McGuire Sponsel, and more specifically for our clients and CPAs. For so long, since TCJA was passed in 2017, we were told, oh, it'll get fixed, it'll get fixed, it'll get fixed, it'll get fixed. And then suddenly in January 2023, it was clear that it was not going to get fixed. And then they continued to promise us that it would get fixed. What would you say some of the challenges? We've rolled this out to all of our clients across the country and had hundreds of calls with CPAs. What would you say are some of probably the biggest misperceptions with 41 versus 174 as we've discussed this with our clients and alliance partners?
I think the biggest problem that we see is they are so connected, but they are two separate issues. So when we look at 174, it's purely a compliance thing. So if you have R&D expenses that are subject to 174, you have to amortize them. There's no ifs, ands, or buts around this. But 41 is a discretionary credit that clients can elect to go after if they have the opportunity and they do qualify for it.
And one of the things that we've run into, and you hit the nail on the head there, obviously one's a requirement, one's discretionary, okay? But it's also the fact of over the past 18 months, well, specifically from January 1 of 23 until September of 2023, the guidance was really unknown. We had very broad guidance, and it wasn't until September 2023 that the IRS came out with very specific guidance on what is 174 cost. And it's not just, it can't be as simple as, okay, my 41 costs are X, and my 174 costs are 115% of that. It really is very specific in the company and the industry, because we've seen some industries that are extremely exposed to 174 if they have a lot of subcontracts. Garrett, now as we're obviously in the midst of the 2023 filing extension deadline season, is that we've really on our second tax year of helping our clients, advising our clients on what is 174 versus 41. Obviously, the 23 tax year is with the IRS guidance that came out in September 2023. What's been surprising a little bit to us, and really sometimes difficult to explain to clients, is how different industries and different companies are exposed to greater 174 costs than others. Let's talk about some of the drivers of that in terms of why certain companies, it's not just simply 115 or 120% of the 41 costs, but it can be a lot greater than that.
Yeah. I look at some of our government contracting clients, and a lot of them are doing heavy research, whether it's for the Department of Defense or the NSA or something like that. The big thing when looking at 174 costs are you either have to have financial risk or own the IP. And with all those types of funding endeavors, they're going to own the IP. So any sort of end product that's developed, that company will own the intellectual property developed. They may not qualify 41 because you have to have both of those pillars, both financial risk and shared research rights. But if you have one of those pillars, they're subject to 174. So hypothetically, you take a battery developer up in the Northeast. Maybe they're fully funded by the government, and it's all considered funded research at that point, but they own all the intellectual property that's developed. So they may not be able to take the 41 credit on that, but they're still subject to 174. So it puts clients in a position where they have to amortize a substantial amount of their costs subject to research, but there's no opportunity to claim the credit.
One thing that we've been talking about internally inside the office for the past year and a half is the trapdoor, is the company that has been claiming the R&D credit, and then once the tax law and once the 174 requirements come into play in 22, they change what's qualified, or they just ignore it. And they're basically saying, hey, we'll pick this up when 174 gets repealed. Kind of walk through the trapdoor of that.
Well, you look at a client that's historically taken the credit, there is back-end information showing that they've had research and development expenses over the past several years they've been claiming the credit. Now, if we go into 22 when it first started, or 23, and they've decided to cut things off, fundamentally their business would have to change. And as we know, as we speak with clients, typically this hasn't happened. So you have an area of exposure saying, okay, historically I've had, let's say, $2 million in R&D expenses, and now I'm down to zero. Why is there a delta? And when in an audit situation, it's easy pickings for an IRS agent to say, like, okay, what are those changes? What happened? Has your business fundamentally changed? If not, then you should have had R&D expenses. And then you're looking at, okay, underpayment in tax, to as a CPA potentially tax preparer penalties because they knowingly put their client in a fraudulent position.
Yeah, it's definitely a slippery slope, and it's one of those situations. It's a lot of difficult conversations, and we've been part of many of those, and where the client's extremely upset with the CPA, and it's a situation where it's not the CPA's fault. Call your congressman, call your senator. I mean, that's really where they've gotten us into the situation, and we're long past finger pointing now, and we're just hoping for a resolution at some point. But the reality is that the uncertainty of 174 is the fact that it's not going to get fixed before 9/15 and 10/15 of this year. It probably will not get done in the lame duck session. It's likely to not be to wait to get addressed until the new Congress is sworn in January of 2025. The challenge with all of this is helping our clients navigate. Obviously, it's extremely punitive, but the credit, going back to 41 versus 174, the credit's wage driven. We've said that for all these years, okay, is that the bulk of credits of our 800 plus clients that we serve across the country, the bulk of those credits are generated from wages. And then you have some that are obviously material costs, heavy supply costs, contract research costs, cloud computing costs, et cetera. But with 174, it's not just the burden. It's not just the burden on those 41 costs. The guidance that came out last September, these special research expenditures are much more broad. And I always think of a circle. When I try to explain 174 and 41 to a client, I think of draw a small circle, that's 41. Draw a really big circle, that's 174. Kind of walk us through some of those SREs and where those are at and what people need to be aware of.
Yeah. So the first given is you look at wages. So when calculating the 41 credit, we're going to use box 1 W-2 or guaranteed payments for an owner to potentially calculate out that. Now expand that to fully burdened wages. So you're looking at a gross wage, you're looking at employer's portion of payroll taxes, et cetera. Those are going to be included in the wage costs that are associated with 174. Now pushing on to contract research, historically it's 65% for the R&D tax credit. We have to include all 100% of associated costs for research and development for contractors. Now we also get into operational and management expenses that are completely outside of 41. So it could be everything from we're depreciating the depreciation for equipment that's utilized for research and development. We're looking at property taxes, utility cost, anything used to pursue patents, et cetera. So like you said, it's that initial circle for a bullseye is your 41 cost. That broader circle, the second ring, it's much more inclusive. And it was the intent of the bill intentionally it was to be punitive because the hope was it was going to push Congress to fix this. And in order to keep that in the back of their mind, it has to affect a lot of taxpayers to push tax law forward.
Well, in our conversations, obviously, I'm sure some of our listeners today have gotten our articles, our communications that we distribute out monthly, is that McGuire Sponsel has been very active with DC and trying to get this repealed and try to educate elected representatives. And really what I've been told in some of the meetings I've sat in is that the Fortune 500 did not put much pressure on Congress. It was the closely held businesses that were. But what's crazy is the Fortune 500, the cost of 174 is so large for the Fortune 500 compared to closely held businesses that it's really, you wish that almost, now obviously we're getting to pure commentary now, but it's really, you wish there was some type of small business provision. You said, okay, Congress, if you can't agree to a dollar amount or you can't agree to fix this, $500 million or go to $1 billion annual revenue, and you have the election, you have the discretion to say, okay, I'm going to expense this or I'm going to amortize it.
Yeah. Because you look at your top 10 U.S. companies claiming the R&D tax credit, they're claiming almost 80% of total credits across the board. So when you look at a lot of the small and medium-sized business we're working with, it's a fraction of that effect. So when you look at the implications of 174 for tax purposes to help balance a budget, those big companies can probably shoulder the weight for the rest of the smaller companies in the grand scheme of things.
Sure. Actually, this morning I was on a call with a prospect, and they've never taken the R&D credit before, and a Midwest-based company is that, and I was explaining to them how when you decide to take the credit, unfortunately, it used to be, prior to 2022, you got the deduction and the credit. It was a double dip effect. Obviously now it's, you take the credit, you have to amortize. Kind of walk us through the math and say, and obviously we're sitting here on a podcast today, we don't have this big whiteboard, but is it when, obviously the year one, you have the R&D credit and 174, it's pretty punitive, but when does it start where the tranches of amortization start layering on top where it's not as punitive? There's actually some benefit to taking the credit even though you have 174 amortization.
Yeah, so just throwing some round numbers out there. Let's say you have $1 million in 174 costs and they're all 41. So you're looking at probably, let's say, an $80,000 credit. In year one, you can only deduct 10% of that. So $100,000 in deductions for those expenses and $900,000 isn't in that year one. So you're going to have there's a pretty big delta there when you're looking at a small company with maybe an effective tax rate of, let's say, 35%. As we push on into those years, future years, the amortized amounts are stacking on top of each other. And typically in year three, you're going to hit kind of that year 3 to 4, you're going to hit that kind of break even. But as we push out into year 4 or 5, you're going to have stacked on top of amortization deductions. So you're going to have a more consistent credit and it's going to be more effective going forward. So what we tell a lot of clients is it's a timing issue. It's the same thing with buying a piece of property where you have to amortize those costs over 39 years, and maybe some of that can be pushed forward into maybe 5, 7, 15-year property. It's a similar metric. It's
just very painful.
It's very painful.
Especially when you got decades-old tax law that allows you to deduct those expenses.
Yeah.
And it's because it's turned into a political football. But yeah, I agree. I think some people, and I think we're very careful in how we say that because I've heard some people, I've been on phones with CPAs and their clients, and the CPA goes, it's just a timing issue. Well, to the client, it's still a funding issue. They don't have access to unlimited bank financing. They got to make decisions. They got to use their working capital to buy inventory, to pay for some of those investments they got to make on a new project. And so it's something that we try to handle this with a lot of empathy because it is extremely challenging for a small business. I can't imagine at McGuire Sponsel some company comes along and says, hey, you got to pay a tax bill on dollars you've already spent to grow your business and expand your business. It'd be very, very hard. But basically what you're saying is that for somebody that has not ever taken the credit before, or a CPA that has a client that has never taken the credit before, is that you basically have about a 3-year runway where you've got to accept some additional tax liability, okay, before those tranches or those layers of amortization stack up to where the benefit comes around. Yep. And that's ultimately what we're trying to advise. And that's what's going to be interesting to see. I mean, you look at it from just a math standpoint. Let's say a client that's started doing this in 2022. By the time Congress gets around to fixing this, we'll be into 2025. Now, the tax bill that was passed in this past January by the House, overwhelmingly with bipartisan support, they called for it was going retroactive to 1/1/22. The great unknown is that when they get around to likely dealing with this in 2025, I would really question if they're going to make this retroactive. And they're just going to say, okay, it's going to be effective in the 25 tax year going forward. Because for those companies that have been taking the credit, they're already out of the punishment zone, if you will. Because in 25, they'll be in a situation where if let's just say it's a repeal, or it's a repeal of it, but they don't go back retroactive, they're going to have all this amortization, all these expenses from 22, 23, and 24 they can start taking in 25 and going forward. So it'll be really interesting to see how they deal with that. It's one thing to deal with, you're sitting here in 23 talking about retroactive to 22, but once you get to 25, I don't see if that's going to be a pretty big dollar amount to go back for a pay for, to go back to 22 and make this retroactive.
Just from an IRS compliance issue, just them handling all the tax returns, like we can't even get them to handle IRC returns or amended returns at this point. They're short staffed. So a simple process is more likely going forward.
Yeah, I really struggle. I don't mean to. Obviously, some companies I know are really counting on that to be that repeal and to be retroactive. I don't see a path right now, just given the expenses and how that's all got to be negotiated in D.C. And it's sad because I see a lot of clients. We have a client that went out of business You know, we had a client that going out of business because they paid their 22 tax bill and they couldn't afford to keep on doing it. We've had clients that have really had to change their business. We were talking, you and I were in Western New York last week, you know, talking about a client that had to make some real hard decisions on how they're going to invest in their business. This is real. This is not it was one of the most insensitive comments I heard was from a senator in one of my calls, is that he literally looked at me on a Teams call and said, "You really think that I'm going to buy into the fact that a small business owner makes decisions on investment based on their tax bill?" That tells you how disconnected they are. Yeah. And it's like, because this is a real thing for companies. And so what we're trying to do is help navigate and help them navigate and be an advocate for them. And, you know, I think of some of our architectural clients. Earlier, you were talking about GovCon, and they sub out some of that to the third parties. We have a lot of architectural and engineering firms as clients, and they sub a lot of that work out to engineering firms. And unfortunately, a lot of that is technically 174. And so we're really trying to go through with a scalpel and say, okay, what aspect of this isn't 174? Because every bit helps, especially if you're a closely held business.
We had a conversation with a client out of St. Louis a couple months ago, and you look at the on paper book, they lost $500,000 because of 174. They almost had a $20 million taxable income just because of 174. Now imagine being a closely held business that in essence owes $7 million, and they lost $500,000 in that year.
Yeah, it's one of those things that it was about a year ago or so. One of our colleagues that we were talking internally, and he said, "This is just a challenge. I mean, it's a bit for a business owner. Do I commit tax fraud by not taking 174, okay, or do I put my business in peril by following 174 and maxing out my line of credit or getting to my line of credit and putting my business in jeopardy?" It's a very difficult, and that's what's for me, us, I think, being on the front lines of this over the past year and a half, that's been the hard part, is sitting there with a client and saying, it's not about whether you made money or not. It's that you've made these investments in your business. You've taken the risk on to develop a new technology or a new part, or to work on a new program, let's say for the Department of Defense, and you spend $1 million of your own money doing it. Now the government's going to say, you're going to pay tax on that $1 million, not tax on the profit. You're going to pay tax. And I know it's a timing issue, but you guess year one and year two, those are 2 big years, and the numbers are really, really difficult for a lot of businesses to absorb.
Yeah, it's troublesome for specifically small businesses. It's a cash flow issue. It has always been a cash flow issue. You look at your Fortune 500 companies that haven't been very vocal about it. They can absorb a couple $2 billion in tax, and they are able to use other tax incentives, et cetera, that they've been stacking up over the years in order to mitigate these first couple of years. But most closely held businesses don't have the ability or even access to the tax planning tools to help offset some of this.
Well, Garrett, thank you for joining us today. And obviously, I hope that all of our listeners understand that this 174 thing is complicated. It's new. There's a lot of still unknowns about it. But at McGuire Sponsel, we're trying to bring reliable solutions, good counsel to help them navigate these difficult times. So, Garrett, thank you so much for joining us today.
Thank you for having me.
Thanks for tuning in today. Remember to subscribe to Let's Talk Tax podcast channel on YouTube to be notified and receive all new episodes.